From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Ferro. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures edging lower as the banks kick off earnings season. JP Morgan misses on loans, Citigroup topping profit estimates. And commodities keep rallying as gold hits another record high. Well, banks kicking off their earnings season with a whimper. JP Morgan disappoints and the market follows it. JP Morgan down some 3.5% so far this morning. Equities then also take a breather. A market that has been noted by the resilience of tech. Tech stocks have done extremely well. The Nasdaq just inches away from a record, but we back off now, again, perhaps because of the pessimism over the biggest bank and reporting loans that missed and deposits that didn't live up to expectations and expenses that were higher than estimated. A bid into bonds, perhaps some short covering ahead of a massive ramp up higher in yields, 30 basis points. Let's get into the macro story. Bloomberg's Michael McKee joins us now with a special guest. Mike.
Well, thank you very much. Susan Collins is the president of the Federal Reserve Bank of Boston, and she joins us now on Bloomberg Radio and television around the world. Thank you very much for getting up in this lovely rainy day here in New York and joining us.
Delighted to be here.
Let's start with the elephant in the room, CPI. It came in hotter than expected this past month, and now you have yourself and others suggesting we're not in any hurry to cut interest rates. Markets seem to be taking this as a policy turning point. Is it?
I wouldn't characterize it as a turning point. So you're absolutely right that the inflation numbers that came in this week were on what I would call the high end of what was expected. And if you look at the first quarter, certainly inflation is elevated compared to where it was as we ended 2023. At the same time, it doesn't change my baseline outlook that inflation will continue to come down with a healthy labor market. I just think it will take more time. And it's premature to tell whether the elevated numbers that we just saw are a bump along that path or something more concerning. So I don't see it as a significant turn, but important to continue to look at the data holistically and let the data tell us what's really going on.
Well, the markets, to go back to them, have priced out everything except maybe 1.5 rate cuts by the end of the year. Is it fair to say that, unlike them, you really don't know what you're going to do?
Well, policy is not on a preset path. And I think that's important. I think there's a maybe understandable desire to have us map out exactly what's going to happen. But in the current environment, what's really called for is patience, being very methodical, and looking at the whole constellation of information, not just focusing on one data reading or another one. And so what I would say is that we're continuing to form our outlook, recognizing that there are uncertainties and there are risks. So I call myself a realistic optimist in that sense, realistic about those risks and uncertainties, but still, for lots of reasons, very optimistic that we will see inflation come back down and that labor markets will remain healthy.
Well, how unconvinced are you that inflation is not going to come down as rapidly as you might have thought?
So I do think that we're going to have to be patient, and it may take more time. That is one of my takeaways from some of the data that we've seen. You know, at the same time, the data are mixed, Mike. So yes, the most recent inflation numbers have been elevated compared to what I might have hoped for. But at the same time, if you look at things like wage rates, so wage growth has been faster than it was pre-pandemic. But once you factor in the past price increases and, importantly, the productivity gains we've seen, the wage growth that we're seeing is consistent with that trajectory back down to 2% inflation. And I think that's good news for workers as well. But my point is that you need to look at the range of data and not focus too much on one piece, and take the time to really see what the takeaways should be.
Well, you said yesterday that the danger of over-tightening has kind of moved out of the picture at this point. growth is strong, unemployment remains low, inflation is at least sticky, if nothing else. Why cut rates at all?
So I wouldn't say that that there is no risk of us waiting too long. I do think that it's two-sided, but to your point, I certainly do see more reason to focus on making sure that we don't start easing too quickly. We're resolute. I'm certainly resolute about that commitment to bring inflation back down to 2%. I do see policy as being moderately restrictive at this point, and it, in my view, will be appropriate as we get closer to that trajectory. It will be appropriate to begin easing, but we're not there yet. So I don't think that we would indefinitely certainly want to stay where we are. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
I have to ask because everybody's going to bring up the question is, does the election interfere with timing?
Absolutely not. As I've said a number of times, focusing holistically on the data is really what determines appropriate policy. And I have to say, there's enough of that to keep us very busy. So that is my focus, and that's the focus of the committee.
You mentioned policy is moderately restrictive. What tells you that? And how do you know what level of restrictiveness you need?
So in terms of the last piece, that's where watching the data comes from. Are we seeing the balance of performance that we're looking for over time? Certainly there's evidence of some restriction. We've seen housing market reactions. We've seen some increase in delinquencies. We've seen some declines in capital spending. And so there clearly is evidence in a variety of places. Labor markets are coming into better balance, and that's a really important one. At the same time, consumption and demand have remained perhaps surprisingly strong given where interest rates are and what we might have thought based on history. But we've seen in a lot of contexts ways that the current context is somewhat different. So I would characterize where we are as policy is having a restrictive effect, which is what we want, but it's perhaps moderately restrictive, and that calls, again, for patience and being methodical as we look at all of the data.
We've now got pricing basically for a December rate cut as markets move back and forth. But my nerdy economist friends have spent the last 2 days putting PPI and CPI into the PCE calculations. And everybody is saying PCE is going to come in much milder than both of those. If that's the case, can we say June might be back on the table?
So I don't want to speculate, again, not a preset path, and I think we have to wait to see what the data tell us. But to my earlier point, the data have been mixed, and CPI and PCE don't always move in lockstep. They certainly are very closely related. And so I think we have to wait and let the data tell us what's happening. And again, it's not just the PCE, although that is certainly the preferred measure that we are focusing on when we look at our 2% target. It's all of it and how it comes together collectively. So wage data will be important. When I look at the price data, I also want to disaggregate and look at what's happening to the different components because the dynamics there are different, and that's informative for trying to understand where we might be going, not just where we've been. The key question is, where are we going, and what's that outlook like? And trying to get to greater confidence before we change the policy stance.
Former St. Louis Fed President Jim Bullard once said during the aftermath of the financial crisis, whatever you think the right rate for the country is, this isn't it. Are you anxious to cut? Do you want to cut? Do we need a cut? Or can we live with rates at this level?
Well, in the near term, I don't see urgency. I had been a bit concerned earlier in the year, very early in the year, that there might be some signs of labor market fragility. I'm seeing much less reason for concern, but that again is why I see the risks as being two-sided. So I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, interest rates will be at lower levels. But exactly what that looks like, it's really premature to be too specific.
the data may be mixed, but what are CEOs in your district saying about both employment growth and also about whether or not they're still having to raise salaries and whether they're going to have to raise prices?
So, and we do have many conversations with people throughout our district, large firms, small firms, throughout New England. And what I'm hearing is a couple of things. One is quite a bit of optimism in terms of the economy's performance overall. I'm hearing information consistent with labor markets really coming into better balance, being easier to hire, except in a couple of sectors like healthcare, where that can still be quite a challenge. So, you know, there are differences across different sectors and localities, but that firms have not been expecting the same kinds of wage increases that they had needed before to retain workers. Quit rates are way down, much less turnover. And that helps with productivity, right? Because if you are focused continually on having to fill those gaps because people are leaving and then you have to train people to come up to speed, it's hard to maintain that productivity that firms really need. And that's part of the good productivity story that we've seen that has helped with economic growth and helped us to bring inflation down as much as we did in 2023, despite the fact that growth has been continue to be so robust. So there's a strong supply side story there as well.
Well, productivity is one half of potential growth, and you're talking about productivity being good. A lot of argument these days that we're seeing more immigration than we're really accounting for, and that basically potential growth is higher than we thought it was. Do you agree with that?
So I certainly have seen increases in labor supply as being a key part of that supply improvement story that has certainly benefited the economy. And the labor supply increases have included immigration, and there's been a lot of work which has come from different people finding similar stories in terms of the increase in immigration playing a role. But we've also seen an increase in labor force participation, particularly in prime age workers, that was not anticipated, and really notably among prime age women, even though we know that the childcare challenges continue, and those are really quite stark. So there have been some surprising supply improvement news, and we'll have to see the extent to which those continue, but it's certainly been an important part of the story so far.
One last question for our money market desk friends. That is, you had a staff briefing and a discussion of whether or not and when to taper quantitative tightening. The agreement, apparently, according to the minutes, was that you should announce it fairly soon. Can we expect something like that at the June meeting?
So no decisions were made. The minutes summarize the discussion that we had, and it really draws from lessons from the past period of quantitative tightening from 2017 to 2019. And some of the key lessons from that experience are the importance of doing the tightening, in other words, runoff of the balance sheet, in a way that is smooth and does not cause stresses. You know, that proverbial should be like watching paint dry, right? It shouldn't be unexpected. And so there was broad agreement that slowing the pace, which is currently about twice as fast as it had been in that earlier period, and doing so sooner to ensure that it continues to be quiet and orderly and passive in the backgrounds, broad agreement for that, and also to start that sooner. But no specific decisions have been made yet.
So we could get taper before we get a rate cut.
Those things I see them as being independent, so that could happen.
Susan Collins, thank you very much for joining us today here at Bloomberg on Bloomberg Radio and television worldwide. We'll send it back to you.
Michael McKee there with the Boston Fed President Susan Collins. Just a fantastic conversation, a lot covered there. Thank you so much. Okay, coming up in the program, big banks kick off earnings season.
We saw a very healthy loan activity that will accelerate for the rest of the year, not only consumer, but really business.
And the results, a mixed bag this morning. We're going to break down the numbers next. This is Bloomberg.
The first quarter sets the base for growth for the rest of this year. And I think the narrative is to be conservative. We certainly have a different economic backdrop is for growth. We saw a very healthy loan activity that will accelerate for the rest of the year, not only consumer, but really business.
Big bank earnings is underway. JP Morgan moving lower. It missed estimates on loans. Citigroup rising on better than estimated first quarter profits. Let's get into the numbers. Here to break it down is Bloomberg's Sonali Basak. Hey, Sonali.
Dani, when we take a look at the numbers here, of course, we know that JP Morgan, what happened here is that they did not raise their guidance for net interest income. And you saw a little bit of a jump there when it came to their annual expense guidance here, partially due to the FDIC-related assessments that many of the big banks are taking on, but also just in general, you do see expenses rising from compensation costs to technology and marketing. Now, what else is going on here? A little bit of caution. When you hear Jamie Dimon talking to analysts now about the consumer, what he says is they're fine. And it's interesting because when you take a look at both Citigroup and JP Morgan here, you do see still spending on cards and still average loan volumes decreasing, but a little bit of weakness when you compare some of those metrics to a quarter ago for some of those banks. So the big question here is what is going to drive net interest income forward at many of these big banks. Certainly JP Morgan is a bellwether. Going into the cycle, they were the most richly traded of those big banks, trading at almost 1.9 times their price to book value. And so it's not so surprising to see a little bit of cards being taken off the table here. The bigger question, Dani, is the read through to the rest of the banking system.
Yeah, we can certainly see in the price action this morning. Stocks down. Sonali, thank you so much. Bloomberg's Sonali Basak. Let's continue the conversation now with Stifel's Barry Bannister and Young-Yu Ma of BMO Wealth Management. Young-Yu, if we have here, as Sonali put it, the bellwether for banks, JP Morgan, a disappointment, shares off more than 3%. It is just one earnings, but what to you does this say about the pace and the market's ability and want to punish those who disappoint in this earnings season?
It's great to be here, Dani. I think the expectations are not high, but there's also probably not a lot of tolerance in this earnings season for misses. So I do think we're going to see some disappointments like this that come up. But I think that overall, given the expectations are not high, we will see some favorable action in earnings performance, but we're not expecting a lot this quarter. We do think we'll see reacceleration of growth in the second half of the year, but I think right now probably warrants some patience.
Even if expectations aren't as high as they have been in the past, Barry, stocks have held up remarkably well in the face of higher yields, and a lot of that is down to the fact that the economy is strong, corporate profits can hold up. So given that expectation, how crucial is this earnings season?
Earnings are important, but what we find is that the stocks themselves respond to the second derivative, the change in the revisions rate. So while tech earnings are great, they have to be ever greater each time they report. On the other hand, some of the more cyclical industries are bottoming out in terms of their negative revisions. And as they turn up, the stock should turn up as well. We're seeing a slight rotation in the market, but right now, tech has been leading, obviously, since last October.
To that point, I mean, Dan Ives over at Wedbush, he is a tech bull, so this quote shouldn't be surprising. But in talking about the earnings, he said that we believe first quarter earnings will be a major positive catalyst for the tech sector and expect tech stocks to be up another 15% for the year, adding to the strong start in 2024. Young-Yu, we're already at a NASDAQ that is inches away from an all-time high. 15%, what do you make of that call?
Well, it is an end of the year call, so it's not necessarily related to this earnings season, but I do think that we'll still see momentum in some areas of tech spending. I think that as corporate spending accelerates in the second half of the year, I think a lot of that will go to technology. I think the data center theme that has been driving some of the markets or some of the stocks will continue as well. And also the idea that productivity growth will kick in eventually. Obviously, we've been seeing that coming from other areas, but productivity growth coming from tech spending could kick in maybe next year. So I think there's still some enthusiasm. I still think that we're not too deep into the technology cycle, that there's as much risk as there might otherwise be, even though we're hitting all-time highs. So I think that forecast is reasonable, but it could be a bumpy ride going forward. It's not necessarily going to be a straight line to that growth prospect.
Young Yu, lucky for us, we've learned to live with bumpy rides over the past 4 years, so it'll feel normal if that's the case. Barry, I know you say you think that tech valuations will be challenged, but we hear from the likes of Wells Fargo who say, look, investors don't care as much about traditional valuation metrics anymore because of the promised land of AI and what that means for future potential. Is there any credence to that?
Well, valuation always matters. We have to discount the cash flows at some interest rate. And as the Fed has stood pat longer than expected, the yield curve is going to flatten one way or the other. Either the long end, the 10-year yield, is going to go up to 5.25, or the short end has to come down maybe 50 to 75 basis points. So we're at that junction, that difficult period where valuation is a little challenged because risk-free returns do offer a somewhat more competitive option for investors. Valuation is something that we consider among other things, but it is challenging right now.
Young Yu, what do you make of that argument that valuation metrics, traditional ones, aren't as important now because of AI and how it's reshaping how we think about these tech companies?
Well, again, I would echo or agree with what Barry said, that valuations definitely matter. But if we think about the momentum can last for a long time. And valuations, if you look at a model, tend to have more of a 3 to 5 year pull on equity markets. So it's not a good timing tool to use valuation. So as long as that theme remains robust, as long as we can get some of that second derivative that Barry was talking about to get increasing upward revisions, I think that will put still strength under the market and a bit under the market. But we are getting somewhat stretched in valuations. It does add an element of risk, especially if we get that long end of the yield curve rising. It does become a much more precarious market with valuations this high.
Don't fight the big Mo. Barry, Young Yu, stick around with us, much more to discuss. Coming up, it's the morning calls, and later we're going to be speaking with Isabel Guzman, administrator of the U.S. Small Business Administration. And small business optimism falls to an 11-year low. That's all ahead. This is Bloomberg. Challenging market for equities this morning. Nothing catastrophic, but down as much as 1% on the NASDAQ, which was just near all-time highs yesterday. So we give some of that back just moments away from the open. Let's get to some of your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, BNP downgrading VF Corp to neutral, seeing numerous headwinds and overly optimistic earning estimates. Next up, Citigroup slapping Sienna with its only sell rating, saying that AI benefits are likely still years away. And finally, Rosenblatt downgrading Arista Network to sell from buy, cutting shares by 2 notches, given its rich valuations and limited AI opportunities. Coming up, we get back to Barry Bannister and Young Yu Ma. Season that's kicked off with a whimper. A challenging morning for equities. NASDAQ underperforming, down some 1% this morning. The headwinds are thus JP Morgan missing on its earnings, and at the same time, renewed geopolitical conflict coming into the fore, with Israel prepared for an attack from Iran in as much as 48 hours. So the risk sell-off is real, but nothing catastrophic. Down by about 0.5% for the Russell 2000 futures. Now, when it comes to the cross-asset price action this morning, it is a bid into bonds. How much of that is short covering after a 30 basis point move over the past 2 weeks? That is a 3 sigma event, so why not cover those shorts? It's also the geopolitics that's driving money into both the 10-year and NYMEX crude, up 2.5%. Again, Israel preparing for an imminent attack from Iran or its proxies in the next 48 hours. Meanwhile, euro sinks this morning. It is dollar bid across the board because of the same things I mentioned, but at the same time, an ECB which is holding steadfast and saying we are independent. We can indeed cut. We can cut in June. We heard from Stenaris this morning saying just that. Euro sinks at 106. Now, of course, the sector to watch this morning at the open, it is banks. It was a mixed bag for JP Morgan, Wells Fargo, and Citi, which reported results this morning. Simone Foxman has more. Simone.
Hey, Dani, well, this idea that the Fed might push off some of its rate cuts and that would be good for net interest income at banks appears to have gotten ahead of itself among investors, especially when you look at Wells Fargo and JP Morgan, where slight misses on their first quarter number, as well as some disappointing outlooks, appears to be weighing on the stocks this morning. Wells Fargo seeing net interest income below expectations, down 8.3% for a previous year, and it maintained its guidance that this metric is likely to be down 7 to 9% from 2023 for this fiscal year. The bank blaming higher funding costs and talking about deposit migration as consumers move to those higher yielding accounts. JP Morgan raking in $23.1 billion in net interest income in the first 3 months of 2024. That's up 11% from a year ago, but it kept its forecast, and that was disappointing for investors. Also raising its expense guidance just a touch, of $1 billion to $91 billion, and that had a negative impact. The only positive today, and the bank trading higher by over 2%, is Citigroup, where net income in the first quarter came in slightly higher than expected, kept its revenue and expense outlook unchanged, and said that consumers are spending more on credit cards and carrying larger balances. That is good for Citibank. Jane Fraser also talking about the organizational simplification program that the bank has been on finally coming to a close. And that is, of course, the only major bank that is up in early trading, Dani.
Simone, thank you very much. So that's the price action. Let's get to the commentary. Sonali Basak joins us. She's been tuning into the calls. JP Morgan underway. Sonali, what have Diamond and Co. been saying?
A few things, and one has a lot to do with the strength of the U.S. consumer. It's interesting what Simone was saying. When you read through the banks and just how much they're growing, when you think about loans and deposits, there are questions about how consumers are spending their money. So how is that being answered is very important here. You have JP Morgan Chief Financial Officer Jeremy Barnum really talking about how incomes have largely been growing in line with inflation. However, there is a segment of the economy where that is not as much the case. Now, the big question then, Dani, becomes when will Main Street's struggles start to catch up to Wall Street? Certainly those Wall Street businesses have seen a lot of momentum, according to JP Morgan executives on this call. Certainly they do give you a note of caution here, but it really pairs well with what you're seeing from their underwriting results, blowing through expectations, positive commentary on the forward look on that pipeline for more investment in banking activity. The question of any weaknesses still remains on how weak the consumer really gets. Again, provisions were fine. The credit quality has been fine, but that slowdown in borrowing, there's an open question on how severe that gets.
Sonali, thank you so much. Shares down more than 3.5%. Stifel's Barry Bannister and Youngyu Ma of BMO Wealth Management are back with us. Barry, Sonali said there that for JP Morgan, it is still strength from a consumer who's willing to borrow, willing to spend. We saw the same from Citi. They're spending on credit cards. How much more space, how much more room does the consumer have to run?
Our view since last year has been that the economy has been recovering from a recession. We called it a pseudo-recession. If you think of a recession as income, production, sales, fixed investment, and employment, the first four actually went negative in real terms from 2022 to early 23. Only employment held up because we have a tight labor market, structurally short of labor relative to demand. So when you think about it in those terms, the consumer is fairly healthy. Wages are growing. Jobs demand exceeds available workers. And I don't think the consumer has much risk of rolling over here.
Barry, Jamie Dimon, though, he said it in his letter to shareholders. He said it in commentary today in his earnings, this idea that we are too far priced in for a soft landing, that markets think it'll be 70 to 80% likely we will get a soft landing. He thinks not so. He says the global landscape is unsettling, that there are terrible wars and violence, inflationary pressures, a lot of risks, which to him would indicate we're not pricing in enough of the recessionary outlook. You say we've already had a pseudo-recession. Does that mean, in your mind, that the recessionary risk is gone?
Well, I think a person like James Dimon has to think about 2025, 2026. And as an investor, we really look a little shorter term. The rest of this year, I don't see much weakness in the workers or the incomes. If I do think about what you're talking about, which is that could the consumer roll over on unemployment spiking and the Fed being too tight for too long, that is a risk next year. But inflation is notoriously late cycle. We're actually seeing the decline of inflation rates that you associate with the end point of a recession and the beginning of a recovery. And as a consequence, the inflation rate leveling out at a level more similar to pre-2008. In other words, the 10 years up to COVID, we were in essentially a deflationary depression ameliorated by Fed policy being super easy. That as the inflation comes down, we should be stabilizing here, and that's bullish for risk assets, which is why we've had a big rally.
Young-Yu, what do you think about the consumer at this point? Would you agree with Barry that if the consumer is challenged, it's going to be a story of rolling over next year?
Well, I think most of the consumers are in good shape here. I think if you take about 2/3 of the consumers, they're in very good shape and at very little risk of rolling over. But I think if you take the bottom third of the socioeconomic classes, they're facing a lot of strains. They face strains from rental prices going up, from inflation straining budgets more than other consumers face. So I think it's more of a bifurcated consumer story rather than a uniform story. So I think that overall, if you look in aggregate, consumers will do very well this year and hold up well. The job market's in good shape. You'll see modest wage gains this year, and I don't see a big risk to spending in aggregate. Now, those companies that are focused on maybe that bottom half or bottom third of the socioeconomic spectrum could see greater challenges. But overall, I think consumer spending will hold up, the labor market will hold up, and the jobs picture will hold up.
Young-Yu, I was speaking with Koku Agablua of SocGen earlier this morning, and he basically said that, look, with all those things holding up and rates remaining higher, risk can do completely fine because, one, companies refinanced in 2021, so the maturity wall is not a problem for them. At least it's not this year. And at the same time, they still have pricing power. They have excess cash. They've put that to work. They put that excess cash to work in money markets. And so if we are higher for longer, then why can't equities keep chugging along? I know we talked about momentum, but is there not just a fundamental level here, Young-Yu, which equities are okay, even if rates are higher and even if the yield curve starts to look different?
Well, we do think so. We do think equities can maintain the positive trajectory here, and even if the yield curve flattens out a bit. But we don't think that the equities would fare that well if inflation actually started to reaccelerate. If we get flat inflation, even if it flattens out around mid 3% here for the rest of the year, we think growth can stabilize the equity market and allow for a positive backdrop for equities overall. So we think there are various scenarios where equities can still do well. It's no longer a Goldilocks scenario where we're expecting multiple rate cuts along with sharply falling inflation and strong growth. But as long as we get level inflation and not damaging interest rate levels and growth kicks in, I do think that's still a positive backdrop for equities.
Well, I'd be remiss that part of the reason that risk isn't doing well this morning, that we're seeing a bid coming into bonds, a bid coming into gold, a bid coming into silver, is because fears over geopolitics. We had reporting not too long ago that Israel is preparing for an attack from Iran in the next, as soon as 48 hours, but certainly in the next few days. Barry, how far away are we from pricing in an expanded conflict? And how much of that pricing in do you want to do at this moment?
I would say that I would fade some of that geopolitical risk right now. Unfortunately, this is very much of a PR war, and Iran's position means that they don't have to overreact because they're doing fairly well so far in the PR war. So as a consequence, they're not going to overreact in terms of responding to the recent Israel actions. As far as the market goes, I fully expect a 5% pullback in the next month or two in the S&P 500, just from the overvaluation and a more realistic assessment of forward earnings growth potential. And I would collar that if I were an investor. I'd put a collar on that with options. But overall, we're more interested in things like the broadening out of the market, the recent strength in equal weighted S&P relative to the S&P, and some of the bounces in value where the earnings revisions were deeply negative and now they're less negative than they used to be.
I'll tell you, certainly get a broadening out, at least into energy on a day like today. Oil up nearly 3% at its highest since October for Brent crude. Barry Young-Yu, I'm afraid we're going to have to leave it there. Barry Bannister of Stifel and Young-Yu Ma of BMO Wealth Management. Okay, let's get more into the tech story. Intel and AMD shares are falling after the Wall Street Journal reported that China has asked its telecom carriers to start phasing out foreign chips. Ed Ludlow has more. Hey, Ed.
Yeah, you can see downward pressure on Intel and AMD, and that's reflective of the proportion of their business that goes into the networking gear market in mainland China. China, as you said, is instructed, according to the Wall Street Journal's report, its two main telecoms carriers to look at their supply chain, look at their networks across mainland China, and come up, this bit's the most interesting because it's granular according to the Journal report, come up with a timeline to replace the semiconductor and other components from domestic supply chain. So it's kind of a continuation of the story that we know about. Huawei, which has kind of been the domestic leader in telecoms networks anyway, has become a catalyst for saying, how are we going to onshore ourselves a lot of this supply chain? You know, they have themselves pivoted their business to a smartphone market. We know all about the Huawei Mate 60 Pro, but they also have a large part of their wider business that goes into networks, and they seem to be trying to work out, as a kind of leader in the field there, how they can do that. But we also know from the sort of parallel reporting about the semiconductors that have gone into their smartphones, that this is a nascent effort where the technology is several generations behind the cutting edge of what US chip manufacturing is capable of. And in the context of telecoms networks in China, none of the names involved in the Journal story replied to them. But these are quite significant moves lower. Intel and AMD both down in the 4% territory this Friday.
Yeah, a tough day across the board. Ed, thank you so much. Coming up on the program, small business optimism drops in the US.
The big mistake that was made in 2021 when people embrace the transitory narrative was they didn't listen to the companies. And the companies were clearly saying, we have inflationary pressures in the pipeline, we have pricing power, we're going to pass on that imported inflation, if you like, that was coming in.
SBA Administrator Isabel Guzman joins us next here on Bloomberg. This week, U.S. small business optimism dropped to a more than 11-year low in March. Sales expectations slumped, and inflationary pressures still remain in focus. Joining us now is Isabel Guzman, Administrator of the U.S. Small Business Administration. Isabel, thank you so much for joining. Great to see you in New York.
Same here. Thank you for having me.
So we had that data. Optimism at its worst since 2011. It's the 7th month decline out of 8. But the economy has surpassed expectations in 2023. And this year, and is still growing. So why is there this disconnect in the data?
Yeah, well, we see with small businesses whom I visit constantly. I'm on the road quite extensively, talking to them, understanding where their opportunities are and the challenges. And there are challenges. They've had to pivot and adapt more than any other time in history. But we're seeing, studies across the board also showing record optimism, and also showing, Wall Street Journal's report just a couple weeks ago showed that 2/3 of businesses expect their revenues to rise in the next 12 months. And they saw a 2-year high in confidence amongst those small business CEOs. So, there's 33 million small businesses in this country across multiple industries and geographies. And, clearly they're picking up on some of the challenges in inflation, the interest rates, and that uncertainty there. But individually, they're seeing revenue growth opportunities. They're retaining their employees. Consumers are spending and walking in their doors with money in their pockets. So we're really trying to track and make sure that the SBA, that's here to help them with affordable capital, can fill those gaps and help them navigate the markets.
What about things like credit? Because credit conditions certainly have gotten tighter for small businesses. Is that where the optimism ends?
I don't think so. I mean, for SBA and its products, we've, in the Biden-Harris administration, released transformations to try to get more, especially small dollar loans, out there. And I think that's reflected in another data point, which is really interesting, and that's that 17.2 million new business applications have been filed since the start of the administration. It's the first, second, and third top years on record. And really, truly, each one of those is a sign of optimism in and of itself to jump in and start your business, but really making sure that they have the capital and the funding that they need. Yes, it's a challenging environment overall, and that's where SBA steps in to fill the market gaps.
What about just general indebtedness of companies? Because there had been this hope that we're going to get Fed rate cuts at some point this year. That seems to be pushed further down the line, if at all. Does it become a problem if we start to reach those points where loans are maturing, they need to refinance and rates are still high?
100%. So capital is only one side of the equation. We really try to focus on those revenue growth opportunities and operational efficiencies through our networks that are on the ground to help these businesses, but as well with the historic investments in America. You know, those infrastructure build projects, those are contracts for small businesses who are then hiring employees who are spending locally. You know, the Inflation Reduction Act and those credits and rebates, well, the trades are going to be able to install those windows, install those HVACs. And so truly making sure that those businesses are connected is the priority right now in the Biden administration. SBA just yesterday released a new Invest in America digital hub, so small businesses could come in and check what opportunities, because they got to focus on the revenues and the efficiencies.
Now, when it comes to raising prices, also in the most recent survey, it said 28% said that they'd raise prices compared to 3 months ago. That's the largest share since October. And plans to boost them further also increased. Does it almost seem like we're in the midst of another upswing in price rises rather than some sort of plateauing off?
Yeah, and I think that that's what's the complex in these numbers. Our PPI came out showing a little bit more stability, right? But we know for the small businesses, it's an issue that they grapple with. They really, it's challenging to assess when they should increase their prices, when their marketing dollars are enough to really keep those customers coming through the doors at a higher price point. So that's one of the things that SBA tries to do with its advisor network. But that is definitely a challenge that small businesses are grappling with.
Well, one of the challenges that seems to have abated, and you need to correct me on this if I'm wrong, is the story about labor hoarding. This idea that companies were unwilling to fire people because they were so unsure whether they could hire again. Has that changed?
My understanding is quits are still low. And when I talk to small businesses, 100% they're retaining their employees. Oftentimes, small businesses give people their first job, which means they're doing a lot of training for our workforce here in America, and they do try to retain so that that cost and inefficiency and turnover doesn't affect their business.
Is AI helping at all? I know all the big companies love to say, we're spending so much on AI, it's going to be the year of efficiency because we can do that. How much are small companies tapping into it?
Well, that was the story of the pandemic, the silver lining, that small businesses adopted technology at such high rates and really saw survival dependent on it. But they are adopting tools, including AI. It's not surprising, of course, that they started using it for marketing, writing their letters, et cetera, but also for customer service efficiency, chatbots, things of that nature. So they are diving in and trying to understand those tools that are available.
So coming around to where we started, because the data is mixed, you are seeing optimism, you are seeing them acting optimistically, hiring, ability to raise prices, consumers are spending. But clearly some people out there are pessimistic if some of the surveys are reading this way. So when you meet with some of these companies, and they are the more pessimistically inclined type, what tend to be their top worries?
Definitely inflation has been a top issue over the last few years, as well as workforce issues, though. It's still, people are worried to make sure that they can retain their employees. It's always top five amongst small businesses. But in addition, they want to make sure that they're positioning their business for growth. I've been very impressed by how the COVID relief dollars and the amount of money that we put in to help save those businesses, save competition in this country truly, has really been leveraged by those businesses to invest in equipment, invest in expansion.
Is there a sense that that's kind of running dry, though?
Those funds are, all of those programs are closed, of course.
Right.
But those investments are what is sustaining our economy as well. They invested in equipment. They invested in positioning their business to go after and compete. And that's what our nation needs.
Yeah, that growth has certainly shown up in the data, mixed as it might be. Isabel, thank you so much for joining this morning. Really appreciate your time. That's Isabel Guzman, Administrator of the U.S. Small Business Administration. Coming up, we're going to get over some of the market-moving events that you need to be watching in Friday's trade and throughout the next week. That's coming up in our trading diary. This is Bloomberg. Banks banks are being spared from the sell-off. JP Morgan down 5% at its lowest in about a year. Citigroup, those gains turn into losses, down 0.7, 0.8, call it 0.9%. Wells Fargo, that's off 0.5% too. It is the fear over the JP Morgan miss, as well as geopolitics, that is weighing on risk this morning. Okay, let's get to your trading diary, what you need to be watching through next week. Fed speak this afternoon. We're going to get that from Bostic and Daly. U.S. Steel shareholders then voting on the Nippon Steel acquisition. Then results from Goldman Sachs on Monday, plus some fresh economic data, including U.S. retail sales. And then finally on Tuesday, we're going to get more bank earnings. Bank of America and Morgan Stanley post results. But so far, the word in is a difficult earnings season, down 5% for JP Morgan. This was the countdown to the open. This is Bloomberg.